Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
Always good to be back.
So the economy, right, it's kind of like, well, if you look at things broadly, things seem pretty solid, wouldn't you say?
Yeah.
I mean, we've seen some positive movement on inflation, even if it's not exactly where we'd like it to be. And the job market, well, it just keeps chugging along.
Yeah, no, I think that's a fair assessment. There are definitely some bright spots out there, but also, some pretty significant question marks, the kind of things that tend to keep policymakers up at night.
Which leads us perfectly into the main course for our conversation today. The latest moves from the FOMC. Holding the interest rate steady, that was interesting. And then, on top of that, signaling a shift in how quickly they're planning to shrink their balance sheet.
Absolutely major decisions, and I'm sure for anyone listening, it's going to raise some eyebrows. Like, how does all of this fit into the bigger economic picture, especially when you've got everyone and their dog trying to predict where the economy's headed next?
Exactly. And just to throw another log on the fire, we've got this new administration coming in, shaking things up left and right. Trade, immigration, how much the government's spending, regulations, the whole nine yards. Like, we're not just trying to understand the economy as it is right now, but also how all these new policies might reshape things down the road and, how the Fed's going to react to all that.
You hit the nail on the head. It's like trying to solve a puzzle where the pieces keep changing shape. So yeah, let's unpack how the Fed is making sense of all this data and trying to navigate these uncharted waters.
Sounds good to me. All right, so first up, interest rates. They decided to keep the federal funds rate right where it is, that 4.14 to 4.12% range. What's the thinking behind hitting the pause button?
Well, from what I've gathered, a message from the committee is all about taking a breath, being patient. They seem to feel pretty confident that the current interest rate level is doing its job keeping things from overheating. And that gives them the space to step back and really watch how the economy reacts to all the tightening they've already done. They're looking for more clarity, more data before making any drastic moves.
Makes sense. And speaking of data, we got that summary of economic projections, the SEPI. What jumped out at you from those forecasts?
Well, if you zero in on those median projections, what you see is a slight, and I mean slight, downward revision to their growth outlook. Not just for this year, but for the next couple of years as well. It's like the consensus in the room is leaning ever so slightly towards a more, shall we say, mellow pace of expansion moving forward.
So a bit of a slowdown on the horizon. What about the job market? Any surprises there?
When it comes to jobs, the projections are pointing to a little uptick in the unemployment rate, but nothing too dramatic. We're still talking levels that historically would be considered pretty darn low. The overall picture still looks like a healthy job market, just maybe with a bit less pip in its step.
Got it. And of course, we can't forget about everyone's favorite topic, inflation.
Oh, inflation, always lurking in the background. So the projections there, they've actually inched up a tad for both this year and the next. However, the good news is that the median expectation is still for inflation to make its way back to that magical 2% target that the Fed loves so much by 2027. It just might take a bit longer to get there than they initially thought, that's all.
Interesting.
Yeah.
Now, what really struck me was that even with these little tweaks to their growth and inflation outlooks, that median forecast for the federal funds rate itself, it hasn't budged an inch from what they were saying back in December, at least for the end of this year and next. Seems like they're thinking on the right level for interest rates hasn't really changed all that much.
You're spot on. However, and this is a big however, it's super important to remember that these projections are just that, projections. They're individual assessments, and they're being made in what, let's be honest, is a pretty uncertain environment. The chair himself said as much. It's not like the committee has huddled together and come up with this grand, unified plan set in stone. Think of it more like a collection of best guesses, each coming from a different corner of the Fed's brain trust.
So the takeaway is, don't go betting the farm on any one specific path for interest rates. It sounds like they're ready to adjust on the fly based on what the data tells them.
Exactly. They've made it crystal clear that they're going to keep their eyes glued to any and all data that relates to their two big goals, maximum employment and stable prices. And if the situation calls for it, they're not afraid to switch gears.
Speaking of switching gears, let's play a little what-ifs. What sort of scenario would make them want to hold interest rates steady for, a good long while?
Well, imagine this. The economy just keeps chugging along, defying expectations. Consumers keep spending like there's no tomorrow. And inflation, that pesky inflation, it just won't go away quietly. In that situation, you can bet your bottom dollar that the Fed would be inclined to keep those interest rates right where they are, maybe even for longer than anyone expects. It's all about keeping a lid on prices.
Okay, flip side of the coin now. What would have to happen for them to even think about easing up on the brakes a little?
All right, picture this. The job market suddenly takes a turn for the worse. We're talking a significant jump in unemployment, something that really catches everyone off guard. Or maybe inflation, instead of being stubborn, decides to take a nosedive. In either of those cases, you can bet the committee would start having some serious conversations about maybe, just maybe, lowering those interest rates a bit to give the economy a little boost. For now, though, they're playing it safe, watching and waiting to see which way the wind blows.
All right, that clears up the interest rate mystery a bit. Now, let's talk about this balance sheet business. They're tapping the brakes on how quickly they're shrinking it. What's the story there?
Right, so first things first, it's important to remember that the Fed's already done a pretty impressive job of slimming down that balance sheet. We're talking over $2 trillion less than what they started with. Now, even with all that liquidity still sloshing around out there, they're beginning to notice some, let's call it, heightened sensitivity in those short-term money markets. It's like, you've got this huge lake and you start draining it, and even though it's still massive, those shallower areas start feeling the effects first.
Sensitive even with all that liquidity still in the system. That's an interesting wrinkle. So, practically speaking, how does this slowdown actually work?
So, starting next month, in April, the amount of Treasury securities they're willing to let mature without reinvesting, well, that's going down, and I mean way down. From $25 billion a month, they're slashing it to a measly $5 billion. Now, here's the interesting part. The cap on those agency mortgage-backed securities, that's staying put for now.
So they're mainly focusing on those treasury holdings, but they're adamant that this isn't some big shift in their overall monetary policy strategy, right?
Right, you are. They've been very, very clear that this is more of a technical fine-tuning. They're basically adjusting the speed at which that balance sheet is shrinking, and it's not meant to signal any change of heart on interest rates. And they're also saying that this won't mess with their long-term plans for how big or small they want that balance sheet to ultimately be.
Sounds like they're just trying to keep the financial markets running smoothly as that balance sheet gets gradually smaller. A little bit of careful maneuvering behind the scenes.
That's a great way to put it. And, this all comes at a time when the Fed is doing this big 5-year review of how they do monetary policy. And get this, at their latest meeting, they were really digging into the whole labor market situation, how it ties into their goal of maximum employment. It's all connected.
Speaking of things being connected, let's talk about inflation. Can't avoid it forever. Most recent numbers, they had total PCE inflation at 2.5% and core PCE, that clocked in at 2.8% for the year ending in February. And there's been chatter about some of those near-term inflation expectations creeping upwards. What's driving all that?
So this is where things get interesting. Powell, in his press conference, he pointed out that when you look at the surveys, both the ones they do with consumers and one of the businesses, there's a growing sense that tariffs are playing a role in these higher new-term inflation expectations. It's like tariffs are becoming this, this character in the inflation story that people just can't ignore.
Tariffs, that's a direct line back to the new administration and their trade policies. But what about the long game? Are those longer-term inflation expectations starting to get shaky, losing their anchor?
Well, here's the good news. If you look at most of the indicators for those longer-term expectations, they seem pretty stable, still pretty much in line with that 2% target the Fed's always talking about. So, yeah, people are definitely worried about how those tariffs are going to affect prices in the short run, but the general feeling is that inflation will eventually settle back down where it's supposed to be. This whole idea of keeping those long-term expectations anchored, that's going to be a major focus for the Fed moving forward. They'll be watching that like a hawk.
It sounds like the Fed's walking a tightrope here. They're saying, hey, yeah, those tariffs, they're probably going to make things a bit more expensive in the near term. But they're also clinging to this hope that, in the grand scheme of things, inflation will cool off. This balancing act, that's got to be playing into their decision to just hold steady for now, right?
100%. You've got this potential upward pressure on inflation from those tariffs on one side, and then this slightly more cautious outlook for economic growth on the other. It's like they're trying to steer a ship through some pretty choppy waters.
All right, let's zoom out a bit and look at some of the broader economic signals. We saw consumer spending ease up after a pretty strong run, and those surveys we talked about, they're painting a picture of growing uncertainty among both regular folks and businesses. What's the Fed making of all this mixed messaging?
That's a great question. And you're right, there's this contrast between what we call the hard data, the actual numbers on stuff like GDP and employment, which still look pretty decent, and the more, let's say, touchy-feely soft data that comes from those sentiment surveys. The surveys are basically flashing a warning sign saying, hey, people are starting to get a little nervous about what might be around the corner, and that's definitely something the Fed's paying close attention to.
But like the chair said, there's not always a perfect match between what folks say in those surveys and how they actually behave when it comes to opening their wallets or investing their money.
That's true. Those surveys, they can be influenced by all sorts of things, and they don't always perfectly predict what's going to happen in the real world. But the Fed knows that. They're smart cookies. They'll be looking for any signs that this dip in sentiment is starting to bleed into those harder economic indicators. If they see spending and investment actually starting to weaken, well, that's when the alarm bells really start ringing.
This brings up that idea of price stability that the chair talked about, that point where inflation is so low and steady that it basically fades into the background of everyday life. People and businesses don't even have to think about it. Are we getting close to that?
So we've definitely made some real progress in bringing inflation down from where it was, but the chair seemed to be hinting that we're not quite there yet. These recent blips in inflation, possibly tied to those tariffs, well, they might slow us down on the road to that true price stability nirvana. The Fed wants to see more evidence, more proof that inflation is on a one-way track back to 2% before they can breathe easy.
All right, let's shift gears to the job market, which seems to be the star of the show right now. Unemployment is low. Jobs are being created. What are some of the finer points, the nuances that the Fed's noticing in the job market these days?
Well, that unemployment rate, it's still sitting pretty at 4.1%. And if you look at the ratio of job openings to unemployed folks out there, that's still elevated, which basically means there are a lot of jobs up for grabs. Wages, they're still going up, but at a more, reasonable pace, and they're generally outpacing inflation now. It's a sign that things are getting a bit more balanced between how many people are looking for work and how many jobs are out there.
Something the chair said that caught my attention was that while hiring rates are pretty low, so are layoff rates. What's that telling us about the state of the job market right now?
That's an interesting observation. What it suggests is that there's not a whole lot of movement in the job market. Companies aren't exactly going on hiring sprees, but they're not kicking people to the curb either. So what that means is that if you're looking for a new job, it might take you a bit longer to find one, even though for those who are already employed, job security is pretty solid. It's like the job market's taken a chill pill.
Circling back to those new policies from the administration, it feels like we're still in the early innings of figuring out what they really mean for the economy.
You got it. It's only been a short time since those policies went into effect, and these things, they don't always have an immediate, obvious impact. It can take a while for the effects to ripple through the economy, and often it's hard to pinpoint exactly what's causing what.
The chair used this really good example about washing machines and dryers, back when they had those tariffs before. The prices for both went up, even though only washing machines were actually targeted. It just goes to show how intertwined everything is and how tricky it can be to predict how one policy will actually play out in the real world.
Yeah, that's a perfect illustration of how complex the economy is. It's like a giant Rube Goldberg machine, and you pull one lever, and who knows what's going to happen on the other end.
Speaking of uncertainty, when you look at the summary of economic projections, it says a good chunk of those FOMC participants are seeing some dark clouds on the horizon, specifically when it comes to economic growth. That seems like a pretty big deal.
It is, and that widespread sense that there are some potential bumps in the road ahead, it just highlights how much uncertainty is swirling around right now. The current data, yeah, it still looks pretty good on the surface, but there's this whole faction within the Fed that's thinking, things might not be as rosy as they seem.
They also took out that line they used to have about the risks to employment and inflation being roughly balanced. Does that mean they're more worried about one of those goals than the other now?
So, according to Chair Powell, taking out that specific language wasn't meant to send a signal that they're suddenly freaking out about either jobs or inflation in particular. He said that language had served its purpose, back when things were different. What matters now is that overall the level of uncertainty has gone up, and the risks to growth, to jobs, and to inflation, well, they've all gone up in the eyes of those FOMC folks.
There's also been some action in the stock market, right?
Yeah.
It's taken a bit of a dip since the last FOMC meeting. Is that something that's keeping the Fed up at night?
Well, the Fed, they definitely keep tabs on what's happening in the financial markets because those markets can influence how their policies affect the rest of the economy. But what they're really looking for are those big, persistent changes, the kind that could have a long lasting impact on things. Those short term blips in the stock market, they don't tend to sweat those too much unless it looks like there's some fundamental shift happening in overall financial conditions. And the chair was pretty clear that when you look at the real economy, the data is still pretty solid, even if those sentiment surveys are painting a less optimistic picture.
Someone asked if what we're seeing now is anything like that stagflation period back in the 70s. What did the Fed say about that?
Chair Powell, he wasn't having any of that. He was adamant that comparing the current situation to the 1970s is just not accurate. He pointed out that before we started seeing those price increases linked to tariffs, inflation was actually pretty close to their 2% target, and the overall economic picture just isn't the same as it was back then. Different beast altogether.
There was also a question about this, well, let's just call it an unorthodox proposal involving sending dividend checks to taxpayers. Not surprisingly, the chair didn't really bite on that one.
Yeah, that's pretty standard operating procedure. The Fed chair tends to steer clear of weighing in on specific fiscal policy ideas because that's not really their domain. They're more focused on the monetary side of things.
Last but not least, the whole issue of other countries retaliating with their own tariffs came up. It sounds like the Fed's already thinking about that as they try to assess what all these new trade policies might mean.
Oh, yeah, they're definitely thinking about it. Chair Powell mentioned that when the Fed staff are putting together their economic projections, they usually include a range of possible scenarios related to trade policy. And that often includes the possibility of other countries hitting back with their own tariffs. It's all part of their risk assessment, trying to figure out what might happen, even if they don't know exactly what form those retaliatory actions might take.
Just to make sure we've got everything covered, let's touch on that decision to slow down how quickly they're shrinking the balance sheet. It seems like those initial conversations might have been sparked by what was happening with the Treasury General account, but it ultimately became a broader decision within the committee.
That's right. It might have started with some technical stuff like those TGA flows, but in the end, the decision to ease up on the pace of that balance sheet runoff was something the whole FOMC got behind. They basically agreed that it was the right move at the right time. The goal is to make sure things transition smoothly as the reserves and the banking system get closer to that level they consider to be ample. And it's all part of the plan they've laid out before for how they're going to normalize that balance sheet. It's not some secret signal that they're changing their mind on monetary policy or that they've decided on a different end game for the size of the balance sheet.
All right, we covered a lot of ground today. So for everyone listening, here's the bottom line. The Fed's holding steady for now. They see this complicated economic picture where the recent data looks pretty good, but there's a lot of uncertainty about what's coming next, especially with all these new policies and those tariffs hanging over everything. And this tweak to how they're shrinking the balance sheet, that's more of a technical adjustment to keep things running smoothly, not some big shift in their overall strategy.
You nailed it. The Fed's in the middle of a pretty big transition, but their goals haven't changed. They're still all about maximum employment and stable prices. And they're going to keep a close eye on all that economic data as it rolls in to help them make those tough decisions down the road. Their ability to adapt, to be flexible, that's going to be key.
Couldn't agree more. So for all you listeners out there, here's something to chew on. How do you think all these new policies from the government and the Fed's response to all of it, how's that going to shape things over the next year? What economic indicators are you watching to see how it all plays out? And how might all this affect your own financial decisions?
It's a good time to stay informed, to really think about all the different forces at work, and to remember that the future, well, it's still a big question mark.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.